Welcome to the Deep Dive. Today, we're diving into one of India's financial titans, HDFC Bank. We've gone through a lot of research, financial reports, stock analysis, the works.
Yeah, and our goal for you today is basically to help you understand HDFC Bank's, critical market role, its financial health, current stock situation, and importantly, does it fit a value investing perspective, especially now?
Okay, so let's kick off with just how big they are.
Yeah.
HDFC Bank. It's not just India's largest private bank by assets. As of May 2024, it was the 10th largest bank in the world by market cap? $145 billion. That's huge.
It really is. And what's key here fundamentally is that the RBI calls it a domestic systemically important bank, a DSIB.
Which basically means too big to fail.
Exactly. And for you as an investor, think about what that means. It's not just some implied government safety net. It's a real structural advantage. It helps them get capital cheaper, pull in more deposits, especially when times are shaky. It builds this protective moat.
And they dominate the market share numbers too.
Oh, absolutely. They've got about 15% of all banking advances in India. And within private banks, an impressive 37%.
And they're spread across so many areas too: retail, business, wholesale, treasury.
Right, and they have those key subsidiaries like HDB Financial Services, plus that merger with HDFC Limited.
Yes, the merger. That was massive.
A total game changer. It created this really powerful, integrated setup, makes cross-selling so much easier, mortgages, loans, investments, all under one roof.
So even though they don't have a huge international presence.
Right. It's mostly focused on NRIs, Indian properties abroad.
Their strength is really that domestic dominance and this diversified model that makes them incredibly resilient.
Precisely. A cornerstone of India's financial system, really.
Okay, but even giants face challenges. Let's dig into the financials. Because despite that amazing long-term picture, 21% CAGR and net profit over 5 years, 16.4% median sales growth over 10. That's strong.
Very strong. And the balance sheet looks solid, too. Good capital adequacy ratios. That CET1 at 17.23% is well above requirements. And their bad loans, the NPAs, are remarkably low. Gross NPAs just 1.33% as of March 2025.
But there's always a but, isn't there? What about the recent profitability squeeze?
Yes, that's the crucial point right now. Despite the great history, the core lending profit seems under pressure. That trailing 12-month net interest margin, the AM, it was reported at 0.0%.
Zero. Wow.
Yeah, and even projections of negative financing profit from late 2023. That's quite a contrast to their usual performance. It's something to watch closely.
And the stock market seems to have picked up on this, perhaps. The 10-year stock price growth, 14% CAGR, is actually lagging behind their profit and sales growth.
It suggests the market might be pricing in some of these concerns, yeah. Which brings us to the stock itself. It's trading near its 52-week highs on the NSE, around 2006, in a nice upward channel long term.
Okay, sounds positive so far.
Well, yes, but there are mixed signals. The NSE Relative Strength Index, the RSI, isn't showing overbought yet. But the ADR listing, its RSI and stochastic oscillators are flashing overbought.
Okay. So different signals depending on where you look.
Exactly. And add to that some detected abnormal volumes recently, and this sort of poor link between trading volume and price peaks. It kind of suggests the recent climb might be running out of steam a little. Maybe a short-term pause or even a pullback could be on the cards.
Interesting. Now, beyond the numbers and charts, there's the regulatory side. HDFC hasn't had perfectly smooth sailing there either, has it? There was that recent FIR against the CEO, June 2025, over a loan recovery issue. The bank strongly denies it, of course.
Right. And that's not the only instance. They've faced RBI penalties before. Remember when they had to stop issuing new credit cards back in 2020?
Oh, yeah, because of system outages.
Exactly. And fines for KYC noncompliance, too. These things, they highlight that managing operations at this scale is complex, and it can definitely chip away at reputation and, investor confidence.
So let's tie this all together. Thinking like Benjamin Graham, the value investing guru, what's the verdict? He'd look at earnings, financial strength, margin of safety.
Right. And when you apply those principles conservatively, well, given HDFC's long-term earnings power, its solid financials, that systemic importance we talked about, and consistent dividends, it actually starts to look potentially undervalued, even at its current price.
Undervalued, even trading at a premium PB ratio compared to peers.
Yes, because that premium might be justified. Its price to book is 2.97x. Peers are maybe around 1.32x median. But Graham would look deeper. The intrinsic value, considering its resilience, its too big to fail status, its diversification, could well be higher than where the market has it priced, especially if this recent NM pressure turns out to be temporary. That suggests there could be a pretty decent margin of safety there for a long-term view.
Okay, so summing up, HDFC Bank, fundamentally strong, systemically vital, great track record, but definitely facing some headwinds with recent profitability and ongoing regulatory stuff.
So here's a thought for you to chew on. How much weight do you give that too big to fail status when figuring out a bank's real value? Especially when you balance it against these tangible operational challenges and the market's sometimes fickle reactions. Something to consider as you continue your own deep dive.